It's Friday, 9th of December, and this is your Capital Economics Weekly Briefing. I'm David Wilder, and coming up, we'll be hearing about Lula's return to the Brazilian presidency and whether he'll be able to tackle rampant deforestation in the Amazon. But for now, I'm joined again by Neil Shearing, our Group Chief Economist. Hi, Neil.
Hi, David.
Can we start by looking ahead to next week? Because it's CPI week in the US, and then we have this last flurry of central bank decisions. US on Wednesday, the Fed, Bank of England, and Eurozone on Thursday. And it looks as though we're going to be seeing some kind of downshifting. We're expecting 50 basis point hikes from each of those banks, down from the recent 75-point moves. The Bank of Canada did 50 basis points at its meeting on Wednesday. But Stephen Brown, who leads that coverage, he's saying this could be the end of the bank's tightening cycle. Do you think that's how the outcomes of the coming week's meetings will be taken? Do you think that, in other words, that it'll mark a definite shift in the narrative around this tightening cycle?
Well, I think the Bank of Canada are probably close to the end of the tightening cycle than other central banks in the advanced world. But I do think that in the case of the Fed, for example, I think we might be getting close to the end of the tightening cycle too. For others, it may not be the end, but it might be the beginning of the end. I think one thing that's true across most central banks, perhaps with the exception of the ECB, is that there's now a bit less focus on the pace of tightening, whether it should be 100, 75 or 50, and a bit more focus on just how far will central banks need to raise interest rates to squeeze inflation out of the system. The ECB is still a bit more focused on the pace of tightening, but I suspect that by the time we get into next year, early next year, the debate there will shift too. So I think that the debate is shifting away from scrambling to get back ahead of the curve on inflation, and do we hike by 100 or 75, or should it be 50, and the pace of tightening, and much more towards the terminal rate. In other words, how far do interest rates ultimately need to be raised?
It's striking. I'm reading through these previews of these central bank meetings, our central bank watches, which go out a week before the meeting. And as you say, there is a tonal difference in discussing the Fed and the Bank of England versus what we expect the ECB outcome to be. Andrew Kenningham talking about the possibility, at least, of a 75 basis point move next week, even though our forecast is for 50. Why is there this apparent divergence, do you think, between the US, the UK, and Europe?
Yes, that's right. We forecast 50 basis point increase by the ECB in the coming week. We wouldn't be surprised to see a 75 basis point increase. And our forecast for the terminal rate's a bit higher than what is currently priced into markets too. I think one of the features of this whole inflation cycle and the monetary policy tightening cycle has been that the US has tended to lead the UK, which has tended to lead Europe or the Eurozone. So inflation picked up first and accelerated more quickly in the US initially, and then it took a while to filter through in Europe. And the same is true of the monetary policy tightening cycle. The Fed was first off the mark and has raised rates more aggressively in this cycle so far. So I think there's a sense in which the ECB has a bit further to go. It's been a bit further behind in this story, just because inflation's been a bit slower to pick up in the Eurozone, and so they're still playing a bit of catch up there. So I think that accounts for the fact that there's still a debate about should it be 75, should it be 50, rather than just how far do we need to raise rates. That's been less of the focus so far. I think everywhere, though, central banks are grappling with this idea that we've discussed in the past on this podcast, which is because the old models of forecasting inflation have been shown to kind of fall short in this cycle, the old frameworks for thinking about inflation are perhaps a bit deficient now. How far do they need to raise rates? And what's marked the ECB out is a number of members of the governing council are talking about having to put more weight on actual inflation rather than forecast inflation when thinking about how far rates might have to be increased. That obviously leads you to a possible risk that they over tighten.
And I guess there's a flip side of that. And talking just about the messaging that comes with next week's decisions, we've seen, particularly with the US, where at the merest hint that there could be a shift in the aggressiveness of tightening and markets start partying. To what extent are central bankers going to have to be careful next week in making sure the market gets the message about their policy intentions and the fact that presumably the battle isn't over yet?
I think this is the big challenge facing central banks, is that there's a risk that if they send too strong a signal or even given a hint that they might be approaching the end of the tightening cycle, that markets move slightly ahead of where they'd like them to get to, financial conditions loosen, perhaps prematurely in the eyes of central bankers, and that therefore they have to tighten further in order to get financial conditions to tighten again. So communicating their policy intentions, I think, is incredibly difficult. Now, we've done some work looking at what's happened at the end of previous tightening cycles. And I think for this reason, it becomes quite quickly apparent that central banks almost never pre-announce the fact they've ended the tightening cycle. They almost never communicate at the end of the actual tightening cycle that this is the end for exactly that reason. So I think that the challenge of communication is a substantial one. And I think it's for those reasons that we shouldn't really be expecting the Fed or any other major central bank for that matter to give us a very strong hint that they've finished tightening.
This idea of staying the course, it feeds into a lot of the financial commentary around the central bank predicament, particularly in the US. Policymakers shouldn't be like Arthur Burns, the Fed chair in the early 70s, who's always been accused of easing policies too soon and reigniting inflationary problems in the US. And they should be more like Paul Volcker, who's seen as this model inflation fighter who dared push the economy into recession to win the battle. At the heart of all this fear that once again we're going to end up with wage price spirals, and it feels like a very 1970s framing. And we're speaking in the UK, where every day brings news of another group of workers going on strike over pay and conditions. It does all feel a bit like the 1970s in terms of industrial stoppages, but it also seems worldwide. Just to take three examples, you've got Cathay Pacific workers in Hong Kong, steel workers in Korea, in the US. I think rail workers were talking about going on strike. Certainly the New York Times is on strike. And there was even a report that staff at the ECB are considering striking over pay. So are these comparisons with the 1970s justified? Can you talk a bit about wage pressures and how they fit into our general view about what's happening with inflation?
Yes, obviously we've had conversations in the past, and this is a theme that has been recurring. Are we returning to the 1970s? And I think it's easy to get seduced by that narrative. Inflation is an obvious similarity. Industrial unrest, strikes is another backdrop of weak, slowing, negative growth, high inflation, stagflation. It feels very 1970s. And of course, you've got an energy shock going on as well. And one of the salient characteristics of the 1970s was the two big oil shocks. So I think there's lots on the surface that is very similar today to what happened in the 1970s. But our view is the differences are perhaps rather more important. In particular, labour markets function very differently, and product markets are different too because of globalization. But labour markets in particular have been deregulated, they're much more flexible. And I think what's more, if you look across a broad range of labour market data, we're starting to see some signs that conditions are loosening too. So I suspect it's going to be some difficult months over the winter period, particularly in Europe with kind of stoppages and strikes. But I think that as labour market conditions start to loosen, perhaps some wage pressures and will start to ease. I'm more interested actually in the comparisons with the period after the end of the Second World War, and in particular because that entailed a huge shock to the supply side of economy. So during the war, obviously men were mobilized into the army. There was female workers took their place either on the land or in factories. So there's a huge shift on the supply side of the labour market. And what's more, at least in the case of the UK, you had a huge army of workers on the land that were prisoners of war. If you look at the UK's experience after the end of the Second World War, workers that worked on the land, prisoners of war, went back to Germany, and demobbed men from the army had to be kind of reintegrated into the labour force. And of course, the structure of the UK economy had changed through the war. And we saw for about 2 years some really substantial structural pains and frictions in the UK economy. Shortages of miners at one point, shortages of truck drivers at another point, difficulties getting fuel around the country as a result. And then those would start to feed shortages elsewhere in the country too. So you had trouble getting coal around the country. That caused problems for steel mills, for example. All of that, I think, has very real echoes in what's happening today. And of course, you had inflation in part because of wartime price controls being relaxed. So again, differences, but similarities. Now, the important point is that by the time we got to the early 1950s, a lot of those issues had kind of worked their way through. A bit complicated in the case of the UK because of a devaluation at the end of the 40s, but in the case of the US, a lot of those issues have worked their way through. So the lessons from the 1940s and the end of the Second World War perhaps rather more encouraging, and I think the parallels are at least as strong as the parallels with the 1970s.
And I think that informs our view, doesn't it, in terms of how, particularly in the US, how the inflation cycle is going to pan out over the coming months.
Yeah, so we have this view. Our chief US economist Paul Ashworth has been arguing for a while that core inflation pressures will start to ease over the coming months. And one of the surprise stories of 2023 could be the pace at which they moderate. That's partly because a lot of core goods inflation is starting to come off the boil, but also because we know that some of the factors that have pushed up core inflation in the US, particularly shelter and on the services side, medical services, those should start to ease too. So we have a view that core inflation is going to fall and will fall a bit more rapidly than many anticipate next year in the US. A bit slower to fall back in the UK, but ultimately we do get there in the UK and in Europe over the next couple of years. So central banks have a bit more work to do in the short term, but I think over the medium term, by which I mean in the next kind of 2 or 3 years, there's more reasons to think that inflation will stay, at it kind of 2-3%, something like that, than was the case 12 or 18 months ago when central banks were talking about flexible average inflation targeting and perhaps going soft on inflation in order to achieve other goals.
That was Neil Shearing on the inflation outlook. Our US and Europe teams held an online briefing on December 6th about why core inflation in those economies are on different paths. We'll link to a recording of that on the podcast page of our website. Now, Lula's back in Brazil. Luiz Inácio Lula da Silva will become president for a second time in January after a stunning comeback. A little more than 3 years ago, he was in jail. His return has raised hopes that something can be done to tackle the deforestation in the Amazon, which was allowed to carry on pretty much unchecked under outgoing President Jair Bolsonaro. The Amazon's central to the climate challenge, acting as a massive absorber of CO2, but it's been estimated to be losing around 10,000 acres each day from commercial interests. So how much can Lula get done? Or will Brazil's economic priorities prove a distraction? David Oxley, the head of our new Climate Economics Service, spoke about Lula's challenge with our chief EM economist, William Jackson. First, you'll hear David talking about what happened on the deforestation front during the first Lula administration.
Yes, so under his tenure, deforestation in Brazil fell by about 70% from the early 2000s to 2011. Ominously, it's crept back up again under his successor, Dilma, and more recently under Bolsonaro. So it was a golden period for reductions in deforestation when he was last in office.
Yes, and one of the striking things in Brazil is how deforestation plays such a big role in its emissions profile. In some ways, it's quite a green country. There's a lot of hydropower. Electricity generation doesn't generate much in terms of emissions. The industry is relatively small, but it's really the deforestation has such a big impact, doesn't it?
Yeah, and as you say, hydropower is of outsized importance in Brazil, similar in Paraguay. I think in Paraguay, neighboring Paraguay, almost 100% of their power comes from hydro. And Brazil benefits from that, as does Argentina, northern Argentina. But as you say, deforestation really is a sort of vicious circle when it comes to greenhouse gas emissions. So not only does removing trees reduce the size of the carbon sink and the ability of that forest to remove carbon dioxide from the atmosphere, that land, once it's been deforested, is then typically converted into agricultural land, particularly for producing beef and livestock, is also problematic, given that that's a major contributor of methane emissions. So, as I say, it's kind of a bit of a Jekyll and Hyde character in some respects, Brazil, when it comes to emissions.
Yeah, I think you also touched on a really interesting point in a recent report about biodiversity. COP15 is on the agenda, talking about similar issues, and deforestation in the Amazon clearly has a massive risk. Hard to see what the economic impacts are of that, though. Surely important.
Yes, I know exactly. So this is related to the COP15 that's coming underway in Montreal. So looking at biodiversity and maintaining species and making sure we look after the planet. And as you say, it's an uncomfortable truth that in economic circles, we don't value biodiversity. It doesn't get counted in GDP. If a host of species of animals or plants go extinct, that won't actually detract from GDP. They really call economics a dismal science, and in many ways that is true. But the way it is interesting in biodiversity is because it's the real flip side of helping to reduce net greenhouse gas emissions. It goes hand in hand. If you're going to preserve biodiversity and carbon sinks, that will help you, by definition, to preserve the ability of this land to absorb carbon dioxide from the atmosphere. And so, this is where it does touch on the deforestation issue in Brazil. But the key thing I argued in that report was that preserving biodiversity and carbon sinks is very much a necessary condition to tackling climate change. But on its own, it's not going to do a huge amount to bring things down is no substitute for reducing gross emissions. So that's very much where policymakers' focus should be over the coming decades.
Yeah, that's really interesting. I think there's also we've had Lula come to power and a lot of optimism about him being able to play a big role in tackling deforestation in Brazil. But just from my own perspective, looking at this, I think there have to be question marks about whether he can have the same success that he had in the 2000s. One of the big, there's clearly a lot of political willingness both in Brazil and the rest of the world for Lula to be successful here. But the sheer resource side of it in Brazil may be more difficult. From the economic side, there's been a lot more attention on debt risks and big budget deficit that Brazil has been running for years, which means he simply may not be able to dedicate as much resources to monitoring deforestation and increasing security in the Amazon to try or providing financial incentives to curb deforestation.
Fundamentally, I was always intrigued as to where's the incentive to reduce deforestation. I know Brazil is a meat-loving country and eat far more on average beef than per capita than other countries. I mean, it's even with the greatest will in the world to reduce deforestation. I mean, how does that interplay with Brazilian demand for beef? Is that an intractable problem?
I think this could be a really important point of tension. Like you say, David, Brazilians consume a very large amount of beef relative to other countries. It's part of the food culture, and it's going a bit outside our economics areas of expertise, but it's unclear if that's really going to change. And yeah, indeed, Lula, when he won the election, he said, now everyone's going to be able to eat picanha again. Picanha is a Brazilian cut of beef that is very popular. So on the one hand, he's appealing to the electorate with the promise that you'll be able to eat more beef, your incomes will rise, you'll be able to eat more heavier in meat than before. Yet at the same time, he's pledging to curb deforestation, which seems like it would require beef consumption to fall. I mean, there might be technological adaptations that might be able to mitigate some of this, I suppose, but there does seem to be an inherent tension there.
Yeah, no, it's interesting. I was going to say I've read a lot of stuff coming out of Australia about trials of different food additives that they can give to cows and other ruminants to reduce their emissions, as it were. Intriguingly, I remember reading about this particular type of seaweed that you can give to cows. Apparently, it reduces their methane emissions by up to 80-90%, but it's just not commercially viable at this stage. But that's interesting. Well, it's interesting. So he's certainly not pushing Brazil down the vegan path. He's trying to tread the meat-loving path and also while bringing deforestation down.
Definitely. There are some other economic incentives, but I'm not sure how big they are. One area is that the EU is monitoring deforestation very closely. There's actually been a free trade deal. There was decades in the making between the EU and Mercosur, the South American country group that includes Brazil. It took decades to make it. It was agreed, but it hasn't been ratified because the EU is seeking a political commitment from Brazil to curb deforestation. That could proceed under Lula. The issue is there's not. Now there's less appetite in Latin America to proceed with that deal. It's not clear that Lula himself is particularly keen on this deal that was ultimately signed by the Bolsonaro government, and very recently the Argentine government has talked about needing to renegotiate it. So it's not clear if there's a big economic incentive from the rest of the world yet for Brazil to have much success here.
Okay. Just from an outsider of somebody who doesn't follow Brazil as closely as you, I mean, my perception from following the climate side of things is that Lula's been treated as a bit of a rock star since he's been re-elected. He descended on COP27 in Sharm el-Sheikh, declaring Brazil was back, and has become a bit of a darling amongst people, hoping that he's going to be successful reducing deforestation. But am I picking up a sense that outside looking in might be giving him quite a rosy perception, but actually, if you look a bit more closely at some of the domestic challenges he's facing, it's just certainly more problematic looking from Brazil looking out.
Yeah, it's right. I think a good point to bring out that distinction from sort of outside-in perspective. A lot of attention's been on the climate agenda under Lula. Within Brazil, a lot more focus has remained on fiscal policy. It's been the key issue really for Brazil's economy and financial markets for years now. Initially, when Lula was elected, there was a small honeymoon period of a week or two. There were hopes in the markets that he would govern as a pragmatist. He'd given a lot of indications that way. But that honeymoon came to an end pretty quickly once he unveiled some of his fiscal plans, and we've seen much more of that on the past week. Essentially, they're trying to increase social spending quite significantly. The Lula government's plans pointed to spending being about 2% of GDP higher for the course of the next presidential term than had originally been planned. So that's worried investors for two reasons. One is simply that the deficit is going to be bigger, the debt trajectory is going to be on a higher and steeper path. The other issue is that Lula and his team in planning this are using lots of workarounds to essentially undermine Brazil's fiscal rules, and in particular the spending cap. That was a law that was introduced in 2016 to keep growth in federal spending very low to assure investors there will be a return to debt sustainability over the medium term. That started to get eroded under the Bolsonaro government. They found little workarounds, but this seems a more egregious violation of the spending cap. So the anchors for fiscal discipline have really been eroded now. So quite a lot to worry investors in terms of what Lula seems to be planning in terms of fiscal policy. Still things to be worked out. It's passing through, the bill is passing through the Senate. We've seen it be watered down in the last few days, actually. Could be watered down further, but it's moving in an ominous direction.
And does this have any implications for the central bank? If looser fiscal policy, is that part of the concerns that we've seen play out recently?
To an extent, yes. The Brazilian central bank is one that pays a lot of attention to fiscal policy and the country risk premium that then entails. If they're more worried about the fiscal outlook, then interest rates are likely to be higher. And we actually had an interest rate decision on Wednesday evening where they did flag these risks. Possibly you might have expected more stress on some of the risks. They included one or two lines on fiscal risks. So there's something they're watching. Maybe they're waiting for clearer details of how these fiscal plans will actually shape up in their final version. But it's certainly a risk when you're thinking about policymaking. We spent a lot of time talking about inflation and interest rates across the globe over the past year. Brazil's been at the leading edge of this. Inflation started rising last year much earlier than in many countries. They started hiking interest rates too. But also inflation's fallen back a long way. It's now at 6%, down from about 12% earlier this year. So otherwise, the conditions would be starting to get into place for interest rate cuts. Brazil could potentially be one of the first central banks to move in that direction, but fiscal risk might just have to force them to stay their hand.
And that's it for this episode. Check out our website for links to all the work referenced in this podcast, including our analysis of inflation outlooks, the previews of the week's bank meetings, the economics of climate change, and what to expect from the Lula presidency. That's capitaleconomic.com. Next week, we'll be having a special discussion on what to expect in 2023. But until then, goodbye.